Imagine a company that reports sales of more than 4 lakh crore in just 1 year. A company that investors believe was one of the biggest name in India's gold industry. A company that looked so large on paper that its yearly revenue was bigger than the total budget of many Indian states. Now imagine the market regulators ask a very simple question. Can you please show up where this revenue actually came from? At first, this sounds like a normal question. After all, every listed company should be able to explain its sales, customers, and business activity. But according to a shocking interim order released by SEBI, the answer was not simple at all. Documents were reportedly missing or incomplete. Financial statements of the key subsidiaries were not properly available to the public. Different filings reportedly shows different sales number, and as SEBI looked deeper, the mystery kept growing. Eventually, the regulators reached a serious preliminary conclusion. According to SEBI's interim order, around 15.15 lakh crore of revenue linked to overseas subsidiaries appears to be misrepresented. To understand the scale, this amount is larger than the annual economy of many countries. Now, before we go further, a quick disclaimer is here. Everything in this video is based solely on SEBI's interim order. These are prima facie findings, which means preliminary observation based on the evidence available so far. If you did like to verify the fact yourself, you can check the official SEBI's interim order, which is linked in the description below. The investigation is still going on, and this is not a final judgment at all. With that said, let's understand what actually happened, because this case may become one of the most important corporate investigation in recent Indian stock market history. Before the allegations, we need to understand why Rajesh was considered such a big company in first place. For many investors, it was a well-known name. The company worked in gold refining and jewelry and also had international operations. Over time, it builds an image of a global gold business, and if you only looked at a reported number, the company looked extremely large. For example, as per SEBI order, the company reported 2.58 lakh crore revenue in FY21, 2.43 lakh crore revenue in FY22, 3.40 lakh crore revenue in FY23, 2.81 lakh crore in FY24, and 4.23 lakh crore in FY25. In total, over 5 years, the reported revenue crossed 15.15 lakh crore. So these numbers created the image of massive global business. But there was a hidden issue. Most investors only looked at total revenue. Very few asked a question, where is this revenue actually coming from? And according to SEBI, this question became the center of the entire case. The story did not started with a big investigation, not a raid, not a media expose, not a whistleblower. It started with a simple shareholder complaint. So in March 24, a shareholder wrote to SEBI and raised concern about the company. The main concern was usually large receivables. Let me explain what receivables are. So when a company sells good today but receive payment later, the unpaid amount is called a receivable. This is completely normal in business. However, if receivables become usually large or remain unpaid for a long time, it can be a warning sign and may raise concern about the company's financial health. SEBI decided to look deeper. An investigation was started. Later, a forensic auditor, BDO India Services, was appointed. At this stage, no one expected anything major. The goal was simple: to verify financial data. But soon problem started appearing. According to the forensic auditor's observation in the SEBI's order, important records were not fully provided. The auditor faced difficulty in getting complete access to accounting data and supporting documents. Now imagine this situation. You are trying to verify sales of a company. You asked for invoices, you asked for transaction record, you asked for accounting entries, you asked for proof of sale, but the data is incomplete or not available. At that point, verification became very difficult. This was one of the first major concern. But the biggest shock came when SEBI examined the source of revenue. Most people assume that the company earned most of its money in India, but the data showed something very different. According to SEBI's analysis, around 97 to 99% of total revenue came from overseas subsidiaries and step down subsidiaries. This means almost the entire business depend on foreign companies. This is very important because when revenue comes mainly from outside India, investors need clear and transparent information about those foreign entities. With that, it becomes very hard to understand the real business. SEBI says this is where another issue appeared. Importantly, subsidiaries' financial statements were not properly available to investors, even though disclosure required them. And one subsidiary became very important in this investigation. That is Valcambi. According to company disclosure, Valcambi was shown as a major operating part of the group. SEBI compared Valcambi's financial record with the huge revenue shown at group level, and the difference raised serious question. Valcambi's audited financial statement mainly showed processing or value additional income, but at group level, extremely large revenue numbers were being reported. SEBI said the explanation given by the company did not fully match the audited financial data. So regulators asked for more proof, that is customer details, vendor details, invoices, tax records, inventory movement and confirmation. But according to the order, enough supporting documents were not provided for full independent verification. This led SEBI to a major preliminary finding. Based on available information, around 15.15 lakh crore of revenue linked to subsidiaries appeared to be misrepresented. SEBI also estimated that this was around 99.8% of the subsidiary revenue during the investigation period. Now pause for a moment and think about the number. 99.8%, not 10%, not 25%, not even 50%. According to SEBI's preliminary view, almost the entire subsidiary revenue could not be properly verified using the available document. And this is only one part of the investigation. Another issue was inconsistent data. Normally, when a company reports number, they should stay consistent across all filing. If a sales is reported once, it should match in later document. But SEBI found inconsistency. In different submissions, sales number did not always match. Some customers appeared in one record but not in another. Some transaction values were different across filing. These differences created serious doubt about data reliability, because if numbers keep changing, it becomes hard to verify the truth. SEBI also looked at transaction pattern, counterparties and supporting evidence. In several cases, regulators said the information was not enough for full verification. Because of these issues, SEBI decided that immediate action was needed. An interim order was passed while the investigation continues.